benchmarking can mean a lot of things to a lot of different people. So when I talk about benchmarking and trying to compare our property's operations to other properties, I'm specifically looking for very, very granular, detailed information. So we pull a lot of information from our underwriting files when we look at deals that we're buying and try to do comparisons of that. But there's a lot of other data that's available. So what we're going to do is we're going to start out at a kind of a very, very macro level, 30,000 foot benchmarking data. Part of that is just general market research that you can do. So what I'm going to do is I'm going to share your screen and kind of pull up some publicly available data that you have. Right now, you guys should see a market report that's put together by Marcus and Millichap. Typically, these data sources are free to people online that you can, if you have a relationship with brokers. A lot of brokers will pull together this type of market data. This is great information to help you make directional decisions about what markets we're going to be focused on. I'm picking Charlotte because we have a very strong presence in Charlotte. This also could be applicable for different property types. And while I'm looking at the demand drivers and things for the strength of multifamily markets, a lot of these indicators are also applicable to like self-storage or hospitality, other property types that you may be interested in. So typically these free reports will give you information about the employment growth. And when you look at Charlotte for the second quarter, they still believe that there's a large employment growth in that market. They give you good information about where development is coming, which could again impact your ability to drive rents and fill vacancy that you have at your properties. This information is largely free, and it's pretty good because these brokers are in the markets every day, and they have teams of people that are doing analytics that will help you understand what's happening in the marketplace. So I tend to look at this at a macro level and see where like Charlotte compares to the rest of the United States. So when you would get information from, the big news networks or the business networks that say, hey, rents are trending downward, employment's, starting to decrease a little bit heading into the quote unquote a potential recession that may be happening at the end of the year, you can look at this type of data and see that the market that we're interested in, Charlotte, is actually going to perform better than the rest of the country. So those are good indications that you would look at for part of your analysis for looking at your properties. Specifically, these market reports can get into details with regard to construction information and year-over-year vacancy reports. So this is a good trend to look at how our property would stack up compared to the market as a whole. So if you look at the absorption rate and the vacancy rate, right now they're saying the Charlotte market is somewhere between 6 and 8% vacancy rate. Well, if I'm looking at my portfolio and looking at my specific properties, I can see that my property is faring better than the market because, on average, our portfolio is about 96% occupancy. So it means we have about a 4% vacancy rate. You can start to then look at where the rents are, and they can give you like an average rent per unit of $1,582 per month. That's a very broad indication because that tends to include everything in the market. So class B, C, A's, you name it, it's lumped into their data. So it is directionally something that you would want to compare, because if you say our property is average for the market, then it's a good benchmark. If you have a class A, you would note that your property should be significantly higher than what the market shows. So this is just a good example of what's happening in the marketplace for Charlotte. Other sources have similar data. So if you look at Cushman and Wakefield, they produce data for us, and we get these reports from them on a regular basis, and it gives you an idea of where things are moving with regard to occupancy. So their data is somewhat comparable to what we got with Marcus and Millichap. They're saying that the occupancy is actually going down. It's at 93.5%. Again, looking at our portfolio, we're a little bit higher than that, and those data points are important for us. Their effective rents are a little bit different, and again, they're using their data set. They do have the ability to pull some data from pay sources. So if you look at within your own portfolio, you can kind of get information from that, but you could also purchase data that would be available. But this free data also gives you a good indication if you look at like where the stabilized occupancy is, rent per square foot, things like that. Those are good indications of how your property is comparing to others in the market as a whole. One thing I do like to point out is when you are doing benchmarking, it is critical to know that revenue is a very micro market driven factor. So on an MSA level, Charlotte is a very, very large MSA. Rents are all over the place depending on the micro market, where you are on the corner, how you can get ingress and egress into your property really dictates what your the effectiveness of your revenue stream, because revenue is really dependent upon the micro market, whether you're downtown or in Mint Hill or up north in Morrisville. You can have a mix of assets that really drive revenue at a micro level. So you have to be aware of the specifics that happen with regard to the micro market. On the expense side, expenses are more macro. So the MSA level expenses are good indicators to see how your property is stacking up compared to the rest of the assets in the market. The difficulty with doing expense ratios and expense comparison is that data is not free typically. You can't necessarily get that information just on a website doing Google searches. So one of the things I'm going to show you are a couple of reports that we have at a macro level that you can see. Here we have a Yardi report. This is for our Lake Norman property. So they're very much dialed into the specific properties where they're looking at a range of Class A to B plus mid-range assets, and it'll show where our property is compared to the submarket. So you can look at this property, this pool of assets, and see that our property is at $1.57 a square foot. That's great for the micro market that we're in compared to other properties. We're an older property there, but there is still room to grow, which is again is a good indicator because we have the ability to keep pushing rents as the Class A assets get downward pressure, because if there's a downturn in the economy, people can't afford as much rent, so they're going to roll down. So people move from Class A plus to Class A to B plus to Bs, et cetera, et cetera. This will give you just a good indication of kind of where we are from a occupancy standpoint. Also, you have to check, sometimes their data is not 100% accurate. So when you look at Yardi, our occupancy is actually higher than this. So it's based upon how they pull the data. So you have to take everything that they say with a grain of salt, because you have to know where your occupancy is. The day that they called to do their data pull could have been when we had a lot of move outs. So our occupancy was at 92.7. We're currently sitting at 95.4. So just letting you guys know that. But this gives you kind of a benchmark for what the other properties are like around us. Another source is CoStar. CoStar is much more granular. Just a footnote for the difference between like CoStar and Yardi. Yardi typically will pull data from their clients who are using their accounting software. So they have the ability to pull actual operating data. Now, you can't go into Yardi and pull a specific property and get their income and expense data. Yardi scrubs that data, but it does give you some information on the income and expense level. CoStar, on the other hand, is more apartments.com and what data people are actually entering into the system. So when you look at CoStar, their data will be a little bit more granular with regard to the unit types. So you'll look at this comp set that we have, where the studios, 1 bedrooms, 2 bedrooms, 3 bedrooms are, where your property sits on the average in the market for what we're looking at portfolio wise, and then just some grading of revenue across the board, so or rents across the board. Sorry. Just an FYI, the ratings are an internal rating for CoStar, not necessarily reviews from clients or people that have lived there. So you can go through and get a pretty detailed, granular review of how you want to do your comparison, where your rents sit compared to everybody else's. As you can see, this data is a little bit old. Our rents are actually higher than that right now for this subject property. And the CoStar will actually get you a lot more granularity with regard to the data points. So again, this service is not free, but if you have good, strong relationships with brokers, you should be able to get these reports from them, and they can share them with you to help you figure out where your property is in comparison to everything else. These data points are good because a lot of times, like I said, revenue is micro market. So I can look at, and I'm going to jump around here a little bit. If you look at their comp set, that's a pretty wide area around our property. So the reality is I would do a much more focused comp set that says the rents for properties, and hopefully you can see my cursor up here in, Dooley, may not be as applicable to the rent comps down closer to where our property is here in Morrisville. So you want to be able to fine tune what you're comparing, and also making sure that you are comparing the right assets. A lot of times, and I'm going to point fingers at not our management company, because our management company is great. Some property managers will pick the worst performing properties in their submarket to compare themselves to. Knowing the quality of the asset and ensuring that your property is on apples to apples comparison to the benchmark that you're using to drive your revenue stream and how you're charging rents is critical. One of the points that I like to make is we had a property where we were doing major interior renovations, adding washer dryers. The property manager kept sending us reports saying, hey, we are killing it. We're at the top of the market. We're, 96% occupied, and we're increasing our rents, and look how great we are. The problem is when we started digging into their comps, they were comparing themselves to assets pre-renovation. So they were comparing themselves to properties that were 10 years older than our asset, that had not been renovated, don't have washer and dryer hookups. So in reality, they look great against what they used to be, but now that they've done the renovations and have moved up a class and added washer dryers, they had to change their comp set, and they never did. And once we determined that, we realized that they're undercharging. They should have been charging $75 a month for washer dryers instead of $25. So those are the types of things that you have to stay focused on as you start to dig into your revenue side benchmarks. I'm going to kind of switch gears a little bit and go into more granular, true benchmarking. So give me for a second while I change where I'm sharing. I'm going to switch over here. And you guys should see an Excel file right here. So what we've done here is actually, I'm going to switch to a different screen first. Hang on. Sorry about that. Let me start here. Okay, what you're seeing here is a summary for one of our properties in the Charlotte market. So what Yardi is able to do is they are able to aggregate data from all of their clients in a specific MSA. And I'm going to show you how they've done it. So what they've done is our subject property is a 232 unit property. They've done a competitive set with regard to specific assets that meet specific criteria that we identified. And that generated a data set of 5 properties. They also did a submarket data set, which pulled a larger pool from a larger geographic area that still met certain criteria within the submarket, and that has an aggregate of 10 properties. So this is the data pool that we are able to pull out of our Yardi data system. What that does is it allows us to look at our property compared to the rest of the market. So on average, you look at our property, we're rental income per unit at $20,763 a year. This is per unit data, and it's trailing 12 information. So when you look at the competitive set, the properties closest to us that we think are our biggest competition, they're performing better than the average for the submarket, but not performing as well as our property. And then when we start to look at the total income side, you see that we are able to, get a number that we're still performing better based upon how our property is in this market versus others. The beauty about this data set, and I apologize, we have to update. We did not update our subject property. This is actually just data from the competitive set. I'm going to show you our data in a second. But what this does is shows you on an aggregate level how total operating expense for the competitive set and then for the submarket. So you can see at an average how well a property is performing for things like expenses. Because if you look at these numbers, they're pretty average across this data set. So your repair maintenance is $1,238 a unit, and you're $1,127 a unit for this submarket. This is great data to give you directionally how you want to manage your property. One of the things that we like to do is we like to look at ratios. So I'm going to switch to how we view the world. So I'm now sharing our kind of proprietary benchmarking tool that we've created to help us manage the information for our portfolio. So you can look at our property here, and so here's the Yardi data that we were looking at before. We like to convert these into ratios. So when I look at information coming from a specific property, I can look at this and say, okay, the data in Yardi says they have an expense ratio of 38.8% or 08%. Our subject property is at 34.39%. So from an operating expense ratio, we're better than the market. What I've done also is this is each one of our properties in this Charlotte MSA. So you can look at where our portfolio is on an asset by asset basis and how our expenses compare. So let's hit insurance, because everybody's worried about insurance. This property, we're at $868 a unit, $634, $535, and you look at the MSA, in some instances we're higher, in some instances we're lower, and we have to understand that this is something that I will now trigger and say, hey, the average for the market is $380 a unit, and our property is at $567. This is something that I'm going to investigate as to why our insurance costs are higher. What are we doing differently that others aren't? And can we, drive some savings because our expense ratio for insurance is higher? The other thing we've been able to do is this is the aggregate for our entire portfolio. So I'm going to change down here is this is every property in our Charlotte market, which is 621 units. So I have an average cost for each one of our properties, and that rolls up into our summary. So the Charlotte MSA data set here actually is the average cost per unit for our entire portfolio in what we consider the Charlotte market. You can see that our portfolio operates at a 34.5% total expense ratio, and the Yardi data for their MSA is at 38.08. When we start to look at areas of concern, insurance is a concern. We need to start looking at that, but you look at where our utility costs are significantly lower than what the rest of the comp set is paying. So, you know, we spend a lot of time focusing on controlling utility costs. We're being successful doing that. So when we start to look at these data points, you can see where there's areas that we want to look at for concern. So just an FYI, the definition of the categories: repair and maintenance, make ready, recreational amenities, contract services. A lot of times they get lumped into different management companies manage categories differently. So you have to take everything with somewhat of a grain of salt by looking at it and saying, well, I'm going to look at these three categories together, make ready, recreational amenities, contract services, and that totals $1,478 a unit compared to the data set that we're getting from Yardi, which is at 1104. So do I think that there's an opportunity for us to improve there? Yes, I do. And that's where we start to now focus in our attention on where are there improvement opportunities. There is one other data set that I'm going to talk about as we move forward before I open it up to questions, is the resources that you have for underwriting deals. Our team underwrites hundreds of deals a year. We can group them by MSA, and we have the ability to pull that data and aggregate it so that we can get per square foot average or per unit averages for expenses for a much larger data set that's fairly accurate, because it's data that was supplied to us when we were underwriting deals. Now, again, it's not a specific deal that we're going to go in and say, this is apples to apples, but on average, if we have, let's say we underwrote 30 deals that were for sale in Charlotte, and we're underwriting the same quality asset, we can aggregate that data and compare how our performance is against the assets that we are underwriting on historical actual data. It is a lot of work, but the tools we have in place allow us to pull that data and aggregate it in a way that's very, very simple, similar to the way that we did it for our portfolio here with regard to our Charlotte assets. So with that being said, I am going to open it up for questions. Can I answer any questions for people with regard to benchmarking? I'm going to stop sharing my screen so I can look at any Q&A things that we have pulled up. Hang on, here we go. The Yardi data looks very helpful. Do you know if you can buy one-off reports for the submarket area around acquisitions? Yes and no. Yardi's not cheap. We use it because it provides data for multiple asset types. It is a fairly deep system that we can get information on. So it helps us with both self-storage and RV storage and multifamily. So they have really, really good information. CoStar data you should be able to get from your broker. Most brokers have CoStar, some have Yardi. So it is something that you would have to speak to your brokerage community. I don't know if Yardi does one-off stuff. I'm very, very familiar with the Yardi folks. I used to work with their head of their Yardi matrix system back in the day when I was at Aimco. So I've understood his data set for a long time. Did I say your system is proprietary? Our system isn't proprietary. It's based in Excel, but our methodology to aggregate the data and how we pull the information and summarize it is, so like these aren't files that we would share because it's our data for our properties, and how we view the world. So how we aggregate the information is something that's consistent across the board. We are able to do this for both our multifamily assets, for our storage assets, and even for car washes, where we can actually look at the expense ratios and the per unit costs for all property types. So the concept that we're trying to get everyone to be familiar with is how you view your assets and how you operate them is something that you can then take and find a way to aggregate that information so you can identify outliers. So one of the things like we're doing with our car washes is we are looking at our entire portfolio and doing the same thing we did with regard to the multifamily, where we're aggregating all the data for the entire portfolio and seeing what our averages are. Then we're comparing them to industry standard ratios, and then also data from the underwriting assets of what we're looking at to see if we're able to find areas for improvement with regard to our portfolio. Let's see, do you have the same property management across the portfolio? We do. That makes it easier because I can request the data in a certain format. I have done this with different property management companies, and what we tell them is we need the data to be sent to us in a certain format. We get a customized report that basically only has these data points summarized. So you get a detailed trailing 12-month report every month from your property managers, or you generate it yourself. And then we ask them to boil it down into these 5 or 10 data points, typically what you would get from your brokers in a brokerage package, that allows you to quickly summarize the information and then benchmark it across your portfolio or across other assets. Here we go. What are your strategies or actions you're finding to lower or moderate insurance costs? Well, that's a different story than benchmarking. What this webinar is focused on is more identifying problem areas and where there's opportunities for improvements. But it is helpful to have competition in your insurance industry. I'm sure if you guys are like me, you get a phone call from an insurance broker 3-4 times a week that are asking to say, hey, we can save you money and we can do this. Part of it is making sure that you are meeting the criteria that your lender puts in place for the insurance requirements, and B, having the right coverages and not either over or under insuring your properties, and then getting competitive and having your insurance brokers go out and identify providers that can help you. It's difficult in Florida right now, but it will come back again when you get into different areas. So when we look at utility costs, that's a big thing for us. So we can look in and see where our utilities are out of whack, and then go in and do a utility audit or reach out to the local utility providers to have them come in and find out whether we qualify for any kind of green utility treatments that they may have, because a lot of times they could lower the cost for you. Water usage, a lot of times you can identify if you have a water leak, because all of a sudden your bills were slowly inching up. So if you start to do this review and benchmarking, you can identify and say, hey, something's out of whack here. Let's make sure we dig into it. And let me go into one of our chats saying what we pay the management companies varies by market, by property type, and by location. So It's difficult, but typically you can get a property management fee in the range of, again, if it's an institutional quality asset, average size, it's going to range anywhere from 2.5% to 4%. If it's a smaller asset, economies of scale, you're going to pay higher rates. Asset management fees, again, that's not part of benchmarking, because benchmarking is a lot. It's you can't really benchmark asset management fees against other properties because everybody manages their assets differently. So let me see other questions here. Are you able to compare amenities across properties easily? No, that's one of the nuances with regard to benchmarking. It's not perfect. You can't go in and identify, like I said, on the global expense side, amenities aren't going to drive your expenses. On the revenue side, the amenities will. So you have to be very focused. Like I said, the revenue is micro market. It's going to be, the surrounding 6 or 8 properties around you, where you're located within a market or a sub-market. Again, a property that is difficult to turn into could have a lower rate because people, when they go to work, find it difficult to turn into or out of your apartment building. So you end up paying less in rent because people just don't like it. On the expense side, expenses are more macro MSA level. So you should be able to do your benchmarking there. Benchmarking really does drive the expense side at the macro level. Presenting. I appreciate that. There are a lot of numbers here and it is difficult, but again, trying to pull the data from a 30,000 foot level and apply it to your property, that is important. So here we go. Last one. How do you benchmark when you're looking at smaller multifamily assets and compare to those more than 30 miles away? That's a tough one when you have a large geographic area. 30 miles away is from a multifamily side, that's probably not going to be as applicable as it would be if it was a local property. But on, let's say, the RV and boat storage side, when you look at climate controlled RV, people drive for 30, 40 miles to store their RVs. So that benchmark could be applicable depending on the asset type. I don't necessarily think it would be applicable for multifamily, but it would be applicable for different asset types. Are you finding applications or help from using any AI tools or resources? I am not. AI is tough because, again, not all this data is publicly available, so you have to get access to it. We do use a tool for underwriting. I believe it's called Red IQ, which pulls all of the operating expense data in when we underwrite deals and populates our models. That has allowed us to aggregate the income and expense data at a MSA level. So we can identify the 10, 15, 20, 30 properties in the MSA that we underwrote that have a true trailing 12-month data set that we can then upload into Excel to run through our magic box that will pull the average per unit costs so we can do an apples to apples comparison. Okay, we're getting near the end. So let's see. What tool would you recommend when evaluating properties for purchase as an investor? I'm old school. Excel is all I need to find a property. But like I said, our acquisitions team uses a couple of tools to speed up the process because, again, when you're looking at acquisitions, you end up having to underwrite 15 to 20 deals to find 3 or 4 that you want to put an offer in on to get one under contract. So to do a high volume of deals, you have to be able to process a lot of numbers. So you have to find a good, efficient way of pulling all that data in. But once you have that data, you want to be able to use it and make it valuable, which is what we're doing, where we're having our team pull all that data together so we can average everything out, so we can find good information that tells us where we are compared to the market. It's not a magic box that says, hey, we're doing great. There are times where I look at our ratios and say, hey, something's out of whack here. What's going on? And then we have to go and look at what the property is and what the issues are. Like if you have a lease up property, you are going to have much higher payroll costs than you would for a stabilized asset. So you have to understand that when you're looking at your data and make sure that you account for those variables that are available to you. Okay, let's see. Our market has a large base of new product and some small multifamily homes. Yeah, I guess when you look at a fully renovated asset, you would want to then compare, like there's certain things that you can't change. You can add granite countertops, you can add fresh premium vinyl plank flooring, but you can't raise the ceiling from 8 foot to 9 foot. So there are always going to be limitations on what a renovation can do. So when you go in and start to do benchmarking, it's important for you to look at what your data set is and what assets you really want to compare yourself to. So like I said, my example of the property we did the renovations on, they happen to have 9 foot ceilings. So that was a plus because it was built in the early 90s. But we added washer dryers. So you should make sure that when you're doing a benchmarking set, you want to look at the assets that have washer dryers in their units and adjust accordingly. Also how you bill out for utilities. If you add washer dryers and you're not on a RUBS system or a sub-metered system, you're going to end up having more water usage because people with the convenience of a washer dryer in their unit are going to use them more often. So you have to make sure that it's not just a simple point and click. You have to be sure to update your data set and review it on a regular basis. So typically when I meet with our property managers, I have them review our comp set quarterly to ensure that no property has gone through a major renovation or nothing else has happened in the market that would cause us to want to switch from one comp to another. So good benchmarking templates. No, that's why we built our own. The easiest way to say it is almost every broker uses the same 10 income and expense data sets for multifamily. And they also use the same data sets for storage. So it's good to try to roll up your data to those 8 to 10 to 12 line items like I had in our summary where we were doing our per unit comparison. Those data points are there to help make it consistent. The difficult part about that is what people include in contract services may be different than what people do at other properties. So you could have somebody that puts their landscaping costs in repair and maintenance or their security costs in general and administrative costs. So it's not perfect. What it is directional. So that's why I like to look at it and say directionally, how does our property match up and how are we performing on average to the market? And then when we find the outliers, what is causing it and whether or not it's because we are not operating poorly, or if we are operating poorly, or if it is just a unique structure for how we view the world. Like payroll is a perfect example. People can bury payroll costs into their numbers. So if you have people that are self-managing, their payroll numbers may be very, very small because they're not paying themselves. But other properties maybe have a management company that is overstaffed at the property. So you just have to look at it and say, the benchmarking is there to drive the discussion and the investigation. It's not the answer to the problem. It's there to help you make informed decisions as to what you want to investigate and why. So it's one of those things where I look at data month over month, every month when I look at financial statements. When I see an outlier, hopefully my management company created a variance report that explains why there was a spike in utility costs from one month over another. Typically, it is, hey, we got billed twice in 1 month for utilities because it was a 31-month day or whatever it was. Or alternatively, they have a problem where, you know, someone had a leaky toilet and water was running for 24/7 in a vacant unit and our water bill went up. So that is kind of monthly data review. We tend to try to get this data reviewed on a quarterly basis so we can see how our properties are performing. The hard part again is the data sets aren't necessarily going to match up. So the data that we get from our underwriting files is going to be somewhat dated. So I tend to look more ratio wise at those properties than I do on the per unit data set. Because ratios shouldn't necessarily change over time, but your per unit cost may change over time. All right, we are almost done here. I'm just checking to see if anybody else has any other questions before we close out. All right, well, hopefully you guys got a little information on this, and I will see you next time I'm on the webinar. You guys have a great rest of your day.